Module Basics of Option Strategy lecture long put or buying a put option. In this lecture you are going to learn about setup of a buy put option or long put, outlook, risk profile when you buy a put option, option Greek, how its impact when you buy a put, hedging long position with put option, that is long put, buying a put option, that is vertical axis which represent the loss and profit. Upside will be loss and downside, upside will be profit and downside is loss. This is the horizontal axis. You are going to see different strike of a stock in this axis. You can see this side is upside and this side is downside. Let's say for example our stock is trading around 110 right now for example. So all these strike are higher strike and all these strike downside are lower strike. So this side is downside, this side is upside. For example, our stock is trading at 110 and we make some technical analysis or we see open interest analysis, then we make an outlook that our stock is going to fall below 100. We are bearish on that stock. We think this stock will fall below 100. So we decided to buy a put option on that 100 strike. Now if you want to trade a bearish view, you had few options. You can short the stock and you have to cover within a day, because you cannot carry forward a short position over the night in cash market. So your second option start with a future contract. You can short a future contract which is right now trading at 110, or you can buy a put option. In this lecture I will cover that long put option. Another option is there, you can short a call option. We are going to check what is going to happen if we buy a put option and how we can trade our that bearish view with a buying a put option. Let's say stock is at 110 and our view is the stock will fall below 100. So that is the strike in which we think that stock will move below, will be our strike to buy the put option. So we decided to buy a put option on 100 strike when our stock is trading around 110. Let's say for example that put option cost 10 rupees. So we buy the put option and that 10 rupees will be added, that 10 rupees will be subtract from our price, strike price, and 90 rupees will be our break even. So what is the trend? If the stock within next 30 days in our expiry period stay above this 90 rupees, we are going to lose 10 rupees per share, because we buy put option and that put option will be lose its value with the passage of time if stock unable to move below 90 rupees. If the stock fall below 90 rupees, that is our zone where we can make unlimited profit. If the stock fall below, we are going to make unlimited profit, because below 90 our put option will catch up the intrinsic value. But right now as a 100 strike put option we buy is a out of the money, so it has only time value and that time value will decrease with the passage of time. So if your stock unable to move below 90 rupees, you are going to a limited loss. You can experience a limited loss that will be limited to 10 rupees, but you can make unlimited profit if the stock fall below 90. That will be on expiry. if you hold the position for next 30 days. But before it, the trade line, that is T plus 0 line, will be look like this. Initially, if the stock move downwards, you can make some profit. If the stock fall below, you can lose some money. But with the passage of time, that curve will be steep, and ultimately on expiry it will be a payoff diagram that's look like this, with the limited loss on upside and unlimited profit on downside. But if the stock move below your downwards break even. A long put give you the right to sell the underlying stock at strike price, which you choose to short the which strike you choose to long the put option. Buying a put is the opposite of buying a call. A put is an option to sell. When you buy a put, your outlook is bearish. You use long put as an alternative to short stock. Your risk is limited to the cost of the option contract. If you buy too many put contract, you are actually increasing your risk. Option may expire worthless and you can lose your entire investment, because the option are depreciating asset. When you buy option, whether it is a long, whether it is a call or put, if you buy option, with the passage of time, the time value is going to decrease. So your stock have to move in your desired direction very quickly, otherwise the time decay will kill your position. Put can also be used to help protect the value of stocks you already own. These are called protective put or insurance for long stock position. That is the key application of the long put. When you buy put, your intention is to short the stock. That means you want to trade a bearish view, or you own the stock, you had a stock portfolio, you want to protect that portfolio using the put option, that called protective put. Now the problem with the protective put is that it is not necessary that every month the market is going to crash and your put option will give you huge value and protect your portfolio. The cost of applying the protective put every month will cost you, and ultimately after the 12th month you are going to lose money due to that protective put. Every month you are going to lose money due to that protective put. You have to trade that long put for protection. You have to trade. How to trade that put option to protect your portfolio? That is called hedging application. You need to trade long put to hedge your long position to reduce cost of long put. Let's see the setup. Buy a put, strike price at the money or slightly out of the money. With your bearish view, what you can do, just buy at the money. If you buy at the money, it will be pure directional play like a future contract, or you can go slightly out of the money if you are strongly bearish. Generally, the stock price will be at or below strike. Outlook. With a long put, your outlook is bearish, expecting price to fall. Remember that outlook, bearish outlook, must be strong. Try to buy the put option when a stock is breaking down its long-term support with very high volume with the news trigger. That means there is something bad news, uncertain bad news arrived on the stock, and stock is breaking its 2 years, 3 years long-term support and with high volume. That means stock is catching up momentum in downside. It is the time to buy a put option to play your bearish view. Otherwise, if you try to play it with every day, as the stock is falling, you think that you can buy a put option and you can make money, you are a fool. because the put option is going to lose its value if it unable to cross the price of that put option which kept your break even downwards. Net position, it is a net debit transaction because you pay for the put option. Risk profile, maximum risk limited, that the net premium or put price, and that maximum risk will be on upside. Maximum reward unlimited, and that will be on downside. Break even downside, and it will be your put strike minus the put premium you paid. Greeks, delta negative because you buy a put option. Gamma positive because you are on a long option. Theta negative, that's mean with the passage of time your position will lose value because your theta is negative. Vega positive, that's mean with the rising implied volatility your position will gain value, and with the falling implied volatility your position will lose value. When you buy a put option, actually your vega will be high, and if the implied volatility rise, it will help you to retain that the price of the put option. That means your put option will lose value very little with the passage of time. So theta will be little bit slow if vega or implied volatility start rising. Whenever a stock crack down below, if implied volatility start rising rapidly, and if you are on a long put, you can get benefit from it. Even if your stock does not move anywhere and implied volatility starts rising, you can make money. But up in the opposite side, if you buy a put option when the IV is very high, that means option premium is very high, and on the next day IV collapse, your put option will lose its value rapidly. Even the stock does not move anywhere, your put option will lose value and you are going to experience loss. Let's go to strategy builder for more clarification. That is our strategy builder. Let's see, Nifty is trading around 11,650. So that is the ATM strike. Let's say for example we are going to take a monthly option to trade. Nifty is around 11,650, that is ATM strike. So let's say for example we are bearish on Nifty, and that is for example we are bearish on Nifty and we think that Nifty will fall below 11,500 in September month. Right now there is a 24 days to expiry. So as we think that Nifty is going to fall below 11,500, so we are going to buy a put option. That is the put option we buy. You can see the price of put option is 136 rupees. We buy 11,500 put option, and you can see our break even. You can see our break even is below 11,500 because that 136 rupees goes push our break even downwards. The probability of profit, right now the software calculated on the basis of the delta and implied volatility is 29%. That means according to the delta of the option we short, actually we short 0.29. Actually we buy a put option of 20.29 delta, so the probability is 29%. That means there is a 29% probability that this option can be a in the money, and there is a near about 71% probability that this 11,500 strike put option will expire worthless. That means you are going to lose money. You can see the summary where the maximum profit is unlimited if the price fall below. If the Nifty fall below your lower break even, you can make unlimited money. Let's say in this month, before expiry, Nifty fall near 11,000. So you can make 27,000 rupees just investing only 10,000 rupees, 10,200 rupees. So that is the your maximum loss. What is the price of that put option? The put option is cost 136 rupees and you are on 75 share. So your maximum loss is 10,200 rupees and you have to pay it. You cannot use it from the margin. So if the stock fall below your break even, you can make unlimited money. If the stock move upward direction anywhere, it can move anywhere. It does not matter. You are going to lose maximum 10,200 rupees. And that will be happen on expiry, up to expiry. But before expiry, if stock move in upward direction, if the Nifty fall downwards direction, you can make some money. If Nifty move upward direction, you are going to lose money. So it will be a directional play, just like equity stock before the expiry. But as the expiry will approach, time decay will kill you. Let's say for example, Nifty is right now at 11,620. Nifty does not move anywhere and stay in this strike price in this 11,620. Nifty is staying there. It does not move anywhere and time pass. So with the passage of time, you are going to lose money. You can see each and every day you are going to lose money. And your maximum loss is 10,200 and you will experience it in next 24 days. As you can see, 24 days is to expire. There is a 24 days remain to expire. So you are going to lose money each and every day. And that is the amount of theta. Whatever the theta amount you are going to lose. If the stock does not move in your direction, you want the stock to fall and you can make money. But if the stock does not fall and time passes, you can see your theta will increase exponentially in next 14 days. Last 14 days, you can see right now theta is 300 rupees. Theta is 300 rupees. It's indicate that each and every day you are going to lose 300 rupees if stock stay where it is and implied volatility stay where it is. That means if the stock and implied volatility stay same and time passes, then you are going to lose 320 rupees every day. But that time value decay will be faster when the expiry is near about 14 days to expire. You can see 17 days to expire and your theta is minus 355. You can see there is a 15 days to expire and your theta is 375 minus, here it is 14 days to expire, and see how your theta is increase. You can see theta is increasing exponentially just after the when the 14 days to expiry is there. That happened because in last 2 weeks time decay is faster. So when you buy a monthly option and your view is bearish, you buy a put option, make sure that your put option must give a big movement in your desired direction. In case of long put, it must fall massively within next 15 days. Don't try to hold a buy put option for last 14 days. Why? Because in last 14 days theta is very high. Let's see the impact of implied volatility. Before that, you can see the delta is negative. Delta is 28 rupees. That's mean if the Nifty fall 1 rupees, your position will make 28 rupees. That's mean if the Nifty fall 1 rupees, your position will make 28 rupees. You are going to make 28 rupees. You can see as the stock is falling, the Nifty is falling, your delta is increasing. You can see your delta is increasing. And that increase will be high because as the stock is falling, your option is getting into the money. From out of the money, it is getting into the money. So the delta acceleration will begin. So as the stock will move in your direction, if the stock move below your break even, then your haven start. As the stock will move below your break even, your haven will start. The delta will pick up rapidly. A delta acceleration will begin, and with the each rupee fall in Nifty, you are going to make money massively. Now see the impact of Vega. Let's say stock does not move anywhere and time does not pass. Time is still and stock is still. There is no change in time, there is no change in stock. But IV, let's say for example, the IV start rising. Right now the IV is 17.1 on 11,500 strike. Let's say IV start rising in Nifty. The VIX is rising. You can see with the rising implied volatility, you can make money even the stock does not move anywhere. Let's say you buy when the IV was 17, and after your purchase that IV rise to 34. That is the massive rise. You can see even the stock does not move anywhere, you make near about 18,000 rupees. And you can see your break even right now, T plus 0 line break even come upward direction massively, where if the stock move upward, you make money. If the stock fall, you can make money. If the stock move upward, you can make money. If the stock fall, you can make money. That's mean your profit is confirmed. Why your profit is confirmed? Because IV rise. Due to the massive rise in IV, the option premium rise, and that rise give you the opportunity to exit into the profit. But you have to write on that IV. Now in the opposite side, if the IV collapse from 17, let's say you buy a put option and then IV fall to 10, you can see you lost near about all your premium. Even the stock does not move anywhere, time does not move anywhere. Initially you learn that the option premium will decay with the passage of time. You buy the put option paying 10,000 rupees in Nifty for the 30 days, and what you learn that with the passage of time, this put option will lose value, and after 30 days I will lose only 10,000 rupees if stock does not move anywhere. But you don't know that you are going to lose that 10,000 rupees in next day because the IV collapse. If the IV fall, you have not to wait for the time decay to kill you. The IV itself is enough to kill your position. The put option value will be vanished if the IV fall massively. A long put option or a long call option always exposed to Vega. That are the Vega positive trade. When the IV is rising, you can go with a debit spread or a buying option. But when the IV is falling, if you buy option, you are going to lose money. Now you see the impact of delta, theta and vega on a long put. But there is a application of this long put. That is the what a pro trader do. A pro trader does not buy a put option when he thinks the stock will move down. That is the directional play, and pro trader actually does not play directionally buying the put option or call option. Then what he do actually? Let's say for example, you buy a stock. I am going to explain you the protective put right now. You buy a stock that has a payoff diagram like this. If the stock price move upward direction, you can make money. If the stock price fall, you are going to lose money. That is the diagram. Very simple. If the stock move upward direction, you will make money. If the stock fall below, you are going to lose money. You buy a stock and you hold it, but you don't want to sell it right now. You don't want to sell it, and something bad happen. You think the stock price will fall. So what you do? You buy a put option to protect that stock. That is called protective put. Let's see for example. Let's say we buy Nifty stock, Nifty future. For example, let's say you buy 75 share of Nifty, and if the Nifty price go up, you are going to make money. If Nifty price fall below, you are going to lose money. That is the simple diagram. But you want to protect that long position. What you can do? You can add a put option. Let's say we add 11,600 put option. We buy 11,600 put option. As we buy the put option, you can see what happened. If the stock fall below anywhere, it does not matter if the Nifty price crash. It does not matter. You are going to lose only maximum 18,000 rupees. And if the stock Nifty price go up, you can make money. So you take the protection and lock the downside using a put option. That is called protective put. Now how much protection it can give? That depend upon in which strike put option you buy. You can see if you go further lower strike, let's say we buy 11,400 strike put, you can see your protection will be less. That means your max loss will be near about 28,000 rupees. If you come upward, let's say you buy 11,600, 650, 11,700 put to protect near about at the money put. So your maximum loss will be 14,000, 13,000 rupees. Now protecting a 10 lakhs rupees portfolio, a Nifty portfolio will cost you near about 10 lakhs rupees. And if the market crash, you are going to lose only 13, 14, 15,000 rupees. That is very low. That is the power of a put option. When the market crash, if you buy a put option, that put option can give you protection. It can limit your loss to 1%, 2% only. and rest of the money you can save. But there is a trading tactics in put option. Let's see what is the adjustment and the tactics to trade a put option to reduce the loss or to take the insurance at free of cost. Let's say Nifty is around 11,650 and we buy 11,500 put option for our bearish view. That is our bearish view. I show you earlier that our view is that Nifty is going to fall below 11,500. So we buy a put option on 11,500. Right now there is no problem. We are bearish, we buy put option. In next few days, what happened? In next few days, let's say Nifty show bullishness and start moving upward direction. Now we lose near about 5,000 rupees and our maximum loss is 10,200 rupees. But after losing 5,000 rupees, I don't want to lose more. After losing 5,000 rupees, my view is wrong. I think the stock will fall, but the stock start rising. My view is wrong. I lose 5,000 rupees, but I don't want to lose more. And I want, if the stock reverse, that means if start falling again, I will make money. So I preserve the probability and I want to reduce the loss. How you can do it? You have to short a put option in lower strike. Very simple. You buy 11,500 put option and your view is wrong. Put option is losing money. So you have to prevent rest of the premium by shorting another put option lower strike, entering into a debit spread. You can see we create a debit spread by shorting a lower strike put option. Now you can see our max loss is limited to 3,700 rupees. That means if the stock move anywhere upward direction, our max loss will be 3,700 rupees. We are not going to lose 10,000 rupees. Limiting that upside risk from 10,000 to 3,700 rupees, you have to sacrifice something. What we sacrifice? We sacrifice our unlimited profit potential on downside. Our unlimited profit potential on downside now will be limited, and that will be near about 10,000 rupees. A unlimited profit convert into a limited profit of 10,000 rupees, and a 10,000 rupees maximum loss is reduced to 3,700 rupees. That means we improve our risk reward ratio, as well as you can see the break even come closer. The previous years in a short option the break even was 136 rupees below, but right now it's come closer to our trading price. That means we improve our probability. You can see the probability was 29% when you are on a long option. When you buy a put option, as you enter into a debit spread, your probability increased. Now, after creating a debit spread, still Nifty show bullishness. Nifty is moving around 11,500 strike. Nifty is not fall below 11,500. It is moving 11,500 to 11,700 and then decline 11,700 to 11,500. My view is wrong. I think we trade with a bearish view, but Nifty is not falling. So you are going to lose that 3700 rupees if you stay into the trade. Let's say in next few days we decide that we have to pick up the price of that spread what we paid. That's mean we wants to exit without paying a single rupees. How you can do it? You can short another option. Let's say we short 11,400. Come closer. Right now you can see we are going to collect money because we convert our debit spread to a short ladder. So we are in credit. Right now you can see if the stock move upward direction, we are going to make 4,000 rupees. So Nifty is bullish, Nifty is moving upward direction. Now we are going to make money and our probability is converting to 82% rate. That means there is 82% probability that this credit portion will expire worthless. We are going to make money. Right away you can create a ladder or you can create a ratio spread. You can create a ratio spread by increasing the quantity on 11,300 strike. You short one, short another. Still you will be on credit and you can see your break even will be much lower. So even if the stock price fall, after that you can make money, and as the time will pass your spread will convert into a confirm profitable trade. So initially you start with a bearish view, you buy a put option and then that put option start losing money. You manage it by entering into a debit spread. That debit spread also start losing money. You convert that debit spread into a ratio spread, put ratio spread, or you convert it into a ladder. Then you exit taking minimum profit. So what you do? You start with a bearish view and the view was wrong. Then you start managing your position and ultimately at the end of the month you exit with minimum profit. That is very minimum, 2,000 rupees, 1,500 rupees. Because with a wrong view you make money, so it will be little. Like this you can take the put option. Now there is a several application of a put option and there is more than 100 strategy you can build with the put option, or you can combine the future contract. There is no scope to teach all the application. Right now in the next lecture we are going to discuss about our different spread. Thank you for listening.